Today, we will talk about margin of safety, examples, meaning, and FAQ. Margin of safety is a principle of investing that means an investor only purchases securities when their market price is considerably below their intrinsic value. In simple terms, when the market price of a security is much lower than its intrinsic value, the difference is the margin of safety. This approach allows investments to be made with minimal downside risk. The margin of safety principle was popularized by notable investors Benjamin Graham and Warren Buffett. They use both qualitative and quantitative factors, such as assets, earnings, and market price, to determine a security's intrinsic value. By using a margin of safety, they provide a cushion against errors in judgment or calculation, but it does not guarantee a successful investment. For example, Benjamin Graham would buy a stock at a discount to its intrinsic value to limit potential losses. If XYZ stock has an intrinsic value of $162, but its share price is $192, Graham might only consider buying it at $130. This way, he limits his downside risk. Although there is no guarantee that the stock's price will increase, the discount provides a safety margin. In accounting, the margin of safety refers to the difference between actual or forecasted sales and sales at the break-even point. This metric is used in break-even analysis and forecasting to inform a firm's management of the existing cushion in actual sales or budgeted sales before the firm would incur a loss. The margin of safety is the difference between actual sales and break-even sales, while the degree of operating leverage shows how a company's operating income changes after a percentage change in its sales. Here are 4 key takeaways. 1. A margin of safety is a built-in cushion allowing for some losses to be incurred without major negative effect. 2. In investing, the margin of safety incorporates quantitative and qualitative considerations to determine a price target and a safety margin that discounts that target. 3. By purchasing stocks at prices well below their target, this discounted price builds in a margin of safety in case estimates were incorrect or biased. 4. In accounting, the safety margin is built into break-even forecasts to allow for some leeway in those estimates. Hope this would help. Thanks for watching.